If you were watching markets in the last few days or the last week, you would have seen stocks like Palantir take an absolute beating, down over 20% in a few days and now technically in a bear market. Although the pullback was expected, as we've seen it rocket ship this year, up at one point roughly 147% from the start of the year and up 40% in just 1 month. This video is not about Palantir, but that of some the head and shoulders patterns working on both IWM and DIA. Here's a fun statistic. One particular research study done in the 1990s found a 93% success rate. Thomas Bulkowski's study was out of 431 patterns in which 30 gave false signals. Inverse Head and Shoulders, according to Altman, has an 80% plus success rate. Let's start with DIA at roughly $449. Check out this beauty of a pattern that's been forming. Left shoulder formed back in January around $420. Then we got that nasty head down to roughly $370 in April, classic bear trap territory. Now we've seen the right shoulder, and now we're retesting that important neckline. The target, a classic measured move, gives us a rough price target of $500. However, that's if all targets are met, which isn't exactly likely, and we still need to break that all-important neckline around $450. Now IWM, left shoulder around $215 in mid-January, head crashed down to roughly 170 in early April when small caps got absolutely demolished. But look at that right shoulder, bounced clean off that 215 again. Now we have that neckline around 230. If this breaks, we're looking at a measured move to 280. But again, that's if all things fall into place perfectly. However, for these setups to execute perfectly, they need to break the neckline. What makes this technical setup so interesting is the fundamental backdrop we're operating in. Sam Altman, CEO of OpenAI, recently told CNBC, "Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes. Coming from someone at the center of the AI revolution, this perspective carries weight." The numbers support his concern. Since ChatGPT launched in November 2022, the S&P has risen 54% and the Nasdaq has surged 90%. The tech sector now represents 34% of the S&P 500's market cap, which actually exceeds the previous record of 33% set during the dot-com bubble.
The worry that AI is in some bubble, we've all been there for the tech bubble in the 90s.
Well, I definitely see a lot of frothy companies in the market and a lot of stretched valuations. But you also anchoring the market have what everybody knows as the Mag 7, companies with enormous cash flows, CapEx budgets, and profits, and also with really a global reach that we didn't have for the companies back in 2000.
Richard Bernstein, which manages $15 billion, noted that AI stocks look eerily similar to the dot-com stocks of the technology bubble. However, today's tech valuations are at 30 times forward earnings compared to 55 times during the dot-com era, suggesting we might be in a different phase of market excess. While retail investors remain optimistic, there are several indicators suggesting institutional investors are becoming more cautious. Buffett Indicator, which measures total market cap relative to GDP, is currently hovering around 200 to 213%, significantly above its historical trend line. Professional short seller Andrew Left recently announced he's betting against Palantir, citing its absurd valuation. Left pointed out that Palantir trades at 80 times sales with a forward PE ratio of 290 times. His comment, "There's never been a company that has that type of multiple or that type of PE that's not corrected 50%. From a technical perspective, we're seeing increasing distribution days where selling volume exceeds buying volume, even on days when prices rise. This typically indicates institutional selling into strength, while retail investors continue buying. Additionally, August has historically been one of the most volatile months for the market, which adds another layer of caution to the current setup." Look, we are definitely in an AI and tech bubble, and that's why I'm not super confident with the inverse head and shoulders seen on IWM and DIA. However, the combination of technical patterns, elevated valuations, and cautionary comments from industry leaders creates an interesting setup worth monitoring closely. While I can't predict exactly what will happen next, The convergence of these factors suggests we should be prepared for a potential significant market movements. The inverse head and shoulders patterns on IWM and DIA could resolve in either direction, but given the fundamental backdrop and institutional behavior we're observing, it's prudent to stay alert and manage risks accordingly. What's your take on the current market setup? Are you seeing similar patterns in your analysis, or do you think these concerns are overblown? Share your thoughts in the comments below. We'll see you next time.